Retail banking or personal banking, in this case, we talk about financial services offered to clients, and usually we talk about small transaction in nature. Commercial banks. Commercial banks, yes, the main financial intermediary in the economy and the main source for credit to household and business sector. Mainly in case of commercial banks, we talk about the importance of commercial banks at in implementation of monetary policy. As we explained in the previous points or sections, the central bank setting the rule and the commercial banks perform the rules or apply the rules or the regulations from the central bank. Yes, the commercial banks listed and joint stock corporations and the private owned. Okay, commercial banks in this case we talk about maybe deal with the corporate clients or individuals in lending and deposits and another services. The largest commercial banks, in this case, we talk about the household names like Citibank, HSBC, Deutsche Bank, and Barclays. In this case, the bank hold the household name or keep or include the household name. The core business for commercial banks, yes, deposits and lending, but largest commercial banks, this is very important. Largest commercial banks engage in the investment banking, insurance or related services. Yes, commercial banks play a significant role in economic development with the process of the monetary policy in trade, in commerce. What about the services provided by commercial banks? Number one, collection of deposits in case of accepting deposits from the customers. Facilitate the payments with the methods or different methods like checks. Provide loans and advances and facilities, overdraft. Provide credit information. In this case, we talk about the credibility for the businessman and the credibility for clients. Discounting of bills. So in this case, we talk about create the or increase the liquidity. Collection of checks, safety and valuables. In this case, with lockers, you can keep your gold, your wealth in this case. Remittance of money. In this case, we talk about 20 hours services for this bank. What about top 10 commercial banks in the world based on the year 2020? This table, okay. Based on Tier 1 capital. Tier 1 capital, this is the an index or ratio to evaluate how the bank can face financial distress. How the bank can face financial distress. We can use other words that financial health for the bank. Okay, back to our table. This is top commercial banks. Bank number one and number two. Bank number one and number two and number three and number four, Chinese banks. So we know that top four banks out of top 10 made in China. So the first bank, industrial and commercial bank of China. From JP Morgan, bank number 5 to bank number 8, Citigroup, made in USA. Bank number 9, HSBC, UK, and the last number 10, Mitsubishi Financial Group, made in Japan. So in this case, we talk about the top 10 banks in the world based on Tier Capital 1 ratio. The Tier 1 capital ratio introduced after the economic crisis in the year 2010. They saw the economic crisis started with the end of the year 2008. Okay, based on this ratio measure the bank's ability to resist the financial distress. Based on Basel III, what do we mean by Basel? Basel International Committee regulate and manage the banking services or the banking business in the world. Based on Basel Edition 3, the Tier 1 capital should be at least 4.5. In this case, talk about the equity component. Equity component of Tier 1 capital should be at least 4.5 of risk-weighted asset. What do you mean by risk-weighted asset? Risk-weighted assets, we assess the assets before risk and after risk. Before risk, this is the nominal value. After risk, this is after weighted or risk-weighted asset. So the core capital equals shareholder equity, retained earnings, as you learned in the accounting rules. Tier 1 capital adjusts the core capital with risk. Core capital with risk. But remember that cash on hand, no risk. So the weight equals 0. Weight of risk equals 0. Mortgage loan may be the risk 30%, 50% or more. This is Tier 1 capital, commonly known as bank's core capital. What about Tier 2 capital? Tier 2 capital, more risky than the Tier 1 capital because the component of Tier 2 capital, we talk about revaluation, we talk about undisclosed services, we talk about hybrid securities, subordinate debt. So all in all, the Tier 2 capital risky than the Tier 1 capital. What about our regulation or our rule? Tier 1 capital, to calculate the Tier 1 capital ratio, equal core capital divided risk-weighted assets. Core capital divided risk-weighted assets. So this is example or problem number 3.1. Suppose ICBC Bank holds 8 millions in core capital. Okay, this is the core capital, maybe the share value, shares, retained earnings, and so on, and lends out 20 millions to BMW. Lends out, so this is the loan, 20 million. 20 million, this is the nominal value or the asset before risk. Outstanding loan comes with the risk weighting of 80%. This is the risk weight 80%. Calculate the Tier 1 capital. Okay. Risk weighted asset equal the nominal value 20 millions times 80% equals 60%. So we will compare between loan before asset equal loan before risk equal 20. Loan after risk equals 16. So the gap equal 4. This is the value of risk. Tier 1 capital ratio equal core capital at 8 million divided risk-weighted asset 16 millions equal 50%. This percent, good or bad? We need a benchmark. What about the benchmark? Basel III. Remember that. Basel, International Committee, which regulate and organize the banking services around the world. So, based on Basel III, the minimum Tier 1 capital, 6%. This is the minimum. So, in our example, 50%. This is good and very good. Problem 3.2, the same but different gavins. Saving banks. Saving banks in this case, similar to commercial banks in many features. But what about the differences? The differences related to ownership. So maybe saving banks, mutual ownership, and maybe owned by the shareholders who are the account holders or borrowers. So maybe the ownership public, like Egypt. In this model, saving banks available in Egypt in the Egypt Post. Egypt Post. This is the model for saving bank. Okay, this is the main feature. Number two, what about the globally? Globally, when we talk about USA, Saving and Loans Association, S&L, Saving and Loan association or thrift. In this case, we talk about the financing of household deposits and lend retail mortgage. But the main feature for saving banks provide microcredit, small credit, and small facilities. So the saving banks target middle and lower income groups. Middle and lower income groups. In USA, the saving or and loans listed. What do we mean by listed? Shares in stock market. Shares and in stock market. What about Europe? In the Europe, the popular case, we talk about Sparkson. Sparkson, this is the popular model in Germany, and this is owned by federal or local governments. Sparkson set up over 200 years, as we will explain in this the next case study. The same for UK. So, as we explained that the main goal for these saving banks, how to encourage SMEs, how to encourage small and medium enterprises. So this is case study for German saving banks, Sparkson, which set up in Germany over 200 years. Set up in Germany over 200 years. Cooperative banks, this type many similar in many features like saving banks, and we talk about mutual ownership and the conduct retail and small banking services. So the main feature for this model, small banking services. Small banking services. It plays a significant role in many Europe countries like Germany, like Netherlands, like Italy, Austria, and Spain, and Asian countries like India. Okay, the cooperative banks provide financial assistance. This is the main topic. Financial assistance at lowest rate of interest. Lowest rate of interest. The main feature for this cooperative banks, okay, how to achieve the development goals. How to achieve development goals. But recently, large numbers of small cooperative banks consolidate together to create large institutions like Rabobank in Netherlands and Crédit Agricole in France. The same in UK, cooperative banks since the year 2007, 2009, consolidation, okay? In this case, we talk about the diversity of banks. This last top 10 cooperative banks of India, we talk about the examples for the cooperative banks in India. Building societies, this is a mutual institution, yes, and adapt the cooperative principle. Each member, one vote. One member, one vote, regardless the amount of money shared or invested. One member, one vote. Okay. What about the management for building society? Building society managed by board of directors. Board of directors. So in this case, we talk about separation between the management and the ownership. What about the difference between building societies and banks? Banks, corporation, and normally listed in the stock market, but societies not driven by this pressure, not driven by external shareholder pressure to maximize profits. Abnormally, we talk about the societies run with the lower costs and offer cheap mortgage loans with the lower interests. What about the regulations or the barriers? The building society is subject to hard regulations compared with commercial banks. So, for example, it's illegal for building society to increase the fund more than 50%. Example for this nationwide in UK, as an example for national society in UK, credit union. This is a mutual deposit institution, and this is non-profit cooperative institution. Non-profit cooperative institution owned by members. Owned by members. So in this case, the members are the owners and the clients. The what about the works and staff in this credit union? Credit union, many staff works at the part time to decrease the costs. Examples for credit unions in USA: Navy Federal Credit Union. We talk about assets with the value 147.9 billion of dollars. What about some data about this credit union? Around 86,055 credit unions from 118 countries. We talk about savings and shares, 2.1 trillions of dollars, loans 1.8 trillion of dollars, assets 2.6 trillions, and reserves 226.7 billions of dollars.